Hello and welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been in business since 1970, delivering investment research, ideas, insights, and stock picks for more than 50 years. I'm Chris Preston, editor-in-chief, Cabot Wealth Network, and I run our Stock of the Week investment advisory.
And I'm Brad Simmerman, the web editor and chief analyst of the Cabot Wealth daily newsletter. This week, we are going to talk early earnings reactions and what the market has been doing lately. Hint, it's not great. We're going to talk about the rise of the weight loss drugs like Ozempic, Mounjaro, Wegovy, et cetera, and the impact on Eli Lilly and Novo Nordisk, as well as what some of the knock-on effects could be. And then touch briefly on whether we should anticipate investing impact from the situation in Gaza, and we'll hopefully tread pretty carefully there.
Touched that with an 11-foot pole, I think.
Yeah. And later, after that, we'll talk about me coming back from Japan, what some of the investing takeaways were. But before we get into all that,
I'm surprised you didn't start the podcast in Japanese, actually. So that's
I can say, where's my umbrella and where's the hotel? And it's like, Hoteru wa doko desu ka? Okay. There's my Japanese.
That was for Jacob.
But before we get started, Chris, you're up for Defend the Take. And this week you are going to call out another market doomsayer.
Yes. So this time it is one doomsayer I'm not as familiar with. You took down, or maybe we both took down, Michael Burry a few weeks ago for his doomsaying. Now it's John Hussman of the Hussman Investment Trust. I'm not familiar with him. Maybe some those listening are. Anyway, his take is that the market has a chance to be down 63% to return to its historical norms. So that would mean in the S&P would be a pullback of 1,600 points, which would mean its lowest level since 2013, 10 years ago. Okay, historical norms. So as Mike Santolo noted on his webinar last month, the NASDAQ, the average gain in the NASDAQ since the top in early 2000, so basically since the turn of the century, is 4.3% below the historical norm, well over 10% in the NASDAQ. S&P since the turn of the century, 5.9% average gain versus historical average gain of 10%. We've had the dot-com bubble crash, 2000 to 2002, where it was down more. NASDAQ was down almost 80%. 0809, S&P down almost 60%. We had the COVID crash, which was short, but 33% in a month. And now we've been down basically for almost 2 years now. The market is not going to crash 63%. I'm sure I'm bumping up against my time here, Brad. But
yeah, that's time. I wanted to give you a chance to make a final statement there.
There is no part of his premise. I'll just say that part of his premise was he sees a recession happening next year, early next year. He says it won't get better until late next year. There is no recession right now, and there's not a whole lot of people who see it. He says part of what he cites is the Fed-induced yield-seeking speculation. Buckle up. And he says he thinks there'll be a negative return over the next 10 to 12 years in the S&P 500.
So what historical norm is he saying that it's returning to? Is it like an earnings multiple, or what's the...
It doesn't say. I think it's just a performance thing, but this century performance market is underperformed by basically half on...
Yeah. And if the premise is like, all right, well, the Fed was juicing returns because of the easy money fiscal policies and keeping rates low and their quantitative easing programs, 5.5 or 5.9% a year doesn't seem like the juicing of returns actually worked, right?
No. And granted, it was coming off of the huge run up in the 90s that caused the dot-com bubble to burst. But what? Maybe 3 to 4 of the 5 or 6 most famous crashes have happened since the turn of this century. The dot-com bubble bursting, the 0809 recession, and the COVID crash. Obviously, that was very quick and led to a huge post-COVID, or not post-COVID, post-crash run up. but that was also losing a third of its value in 1 month.
Yeah, so I think this is actually a really good way to transition into a little bit of conversation around the market in general.
Yeah.
Right now, intraday low today had the S&P sitting right at its 200-day moving average, which it should be an important zone of support. But you were citing some of the sort of the great declines that we saw. If you look at the S&P weekly with a 200-week moving average, that is a line that we've tagged a number of times during periods of like significant market lows. So like beginning of 2016, we hit the 200-week moving average on the S&P, and it served as support. In 11, after the great financial crisis, it was support. It actually broke below the 200-week moving average in the 08-09 period, briefly broke below it during that March COVID flash crash.
Yep.
And then the October lows in 2022 also coincided with the 200-week moving average. So if we are still in a long-term sort of uptrend dating back to we'll call it 2011, if we're still in a long-term uptrend, you would expect support to come in even if we break the 200-day moving average, even if we break the 4,200 level, which is an important psychological level right now, and is sort of building a zone of support with the 200-day. The 200-week moving average is sitting at 39.35 right now. If we break below that, that becomes that is comparable to the dot-com crash and the great financial crisis in terms of economic impact. So I would posit that it would take a pretty significant recession or a major market crash to even break below that 39.35, 3,900 level. I mean, I think we talked about some Case-Shiller valuation data a few weeks ago that maybe called for the S&P to be closer to 3,000 or 3,600, but it would take a nightmare of a scenario to get there, I would think.
It seems counterintuitive. If part of its premise is the Fed, well, the reason the Fed is so on the table is they can't. The economy is still growing more than they've been able to corral with all their interest rate hikes. Inflation is still, there's no recession in sight, and inflation is still, nearly 4%. So I don't see both that and a recession happening at the same time.
Yeah, and Powell spoke on Thursday, and there were a couple of takeaways. He got called out on the fact that he keeps reiterating 2% without really entertaining discussion of 2.5% as being the stable rate. He also said he doesn't know where terminal natural rates are, but he pointed to the jobs numbers as signaling just a supply demand dynamic where in the pandemic a lot of people lost jobs. When we came out of the pandemic relatively unscathed, all these companies that were preparing for maybe a multi-year shutdown now had tons of hirings, job openings and tons of hiring opportunity. And there were 2 jobs available for every job seeker, which I think he indicated either hadn't ever happened before or hadn't happened since maybe like the post-war period, something to that effect. And he was very, very casual about saying that he doesn't really see the employment picture as being a big factor. Obviously, it is a factor. It's one of their 2 mandates, but he does seem to think that that's sort of normalizing. He did also say one thing that sort of raised the hair on the back of my neck a little bit, which was, if you look around at the economy, does it feel like the economic conditions are too tight? To which he says no. He volunteered a very, very quick no. So I do think rate hikes are still in the cards going forward. But he painted a much rosier picture of the overall jobs environment.
Yeah, and so that we basically have moved right into our number one and our big 3. Earnings were part of this discussion. Has there been anything through a week plus of basically a week of earnings results that you think has truly moved the market or moved people's thinking? Or do you think earnings right now are almost besides the point with what's going on in Gaza, which we'll get to, and also, probably above all, what the Fed says, bond yields at multi-decade highs. Are earnings move the needle much, and will they this earnings season?
I think the macro picture is, especially the 5-year yield, it's knocking at the door of 5% right now. And we had talked about two different versions of disinversion of the yield curve. One is shorter term rates coming lower, which would be good. One is longer term rates going higher, which is the bad way that's happening. And that seems to maybe be the case right now. So I think that'll maybe dictate sort of sector-wide or market-wide response. But at the same time, individual companies are responding well or responding appropriately to their own earnings. So Tesla took a big hit, and hopefully you've got some numbers where you can shed some light there. Bank earnings.
I mean, the stock itself is hitting its is as of this recording has dipped below its post-summer lows. It's 212 right now. So
which is where most of the market is. The S&P equal weight is near its like March lows right now, if not below them. Russell 2000 is right at 52-week lows or thereabouts. I don't know exactly where the market is right now. Dow's below its 200. Like, most stuff is not doing well. So the fact that the high flyers are maybe getting cut down at the knees is not a huge surprise. One thing we saw with bank earnings is that the individual companies responded to how they are adapting to the current market environment. JP Morgan beat on revenues, Wells Fargo beat on revenues, Citi beat on revenues. Diamond, in his earnings assessment, did make note that part of that revenue beat was attributable to their interest income, which he expects to normalize going forward as banks have to start sort of competing for deposits more, right? It's easy enough to just raise credit card rates by 2% and trust that the bank relationship is going to hold up. But once you have to start competing for deposits and raising like deposit rates, that starts eating into bank earnings. So I think we saw a lot of really individualized responses to it. One that I want to touch on before we move past the topic is Netflix, but I don't want to dive into that yet. I want to see.
No, I mean, you can go ahead. I think, the theme we're getting at is earnings are mattering on an individual, company by company, stock by stock basis. And so, we saw with the two mega cap techs that have reported so far, tale of two earnings. Tesla, underwhelmed and stock has tanked, but Netflix did well, which I'll let you elaborate on, and the stock is up.
Yeah, Netflix, I think, was up about 12% on their earnings beat. The big sort of headline number that we can take away from it was they added 8.8 million subscribers versus an expectation of 6.2 million. So they added 8.8 million. Analysts were expecting 6.2 million.
Suits is the reason.
So that's part of it, I think. So we had talked about the streamers a fair amount back when the labor strikes were starting, and saying, okay, well, who's gonna be better suited to navigate this? And one of the pitches for Netflix navigating it well is they're less dependent on new Hollywood content. They can repurpose international content. They can do what they did with Suits, which is sort of capitalize on the closest thing we have to a monoculture. It seems like everybody was watching Billions, and then when Billions ended, Suits was a sort of a close and easier watch analog to it. But the big thing,
Meghan Markle's in it too, we should know.
Meghan Markle's in it, although it's been on like Peacock Plus for the last 9 years, so you could have seen it, but it just seemed to catch everybody by storm during a slow summer without a lot of new content or movies or anything like that.
Probably because no one has Peacock. Very few people had Peacock Plus.
And that leads me to one takeaway. One of the things that's a red flag for me a little bit on Netflix's positive earnings beat and their sort of surprise subscriber jump is the churn. The most recent data indicates a 47% annual churn rate for the major streamers. So churn is paid subscribers canceling subscriptions. Netflix reported 3% churn in the months leading up to its most recent earnings report. Paramount Plus or Peacock, they're closer to like 7-8% churn. Disney's in the fours. So I'm a little bit hesitant to give Netflix full credit for their subscriber numbers when it's so easy to vacillate between streaming services. Where I think Netflix probably has the lead is that people are comfortable with Netflix being their TV equivalent, where it's like they've got a big library of content. It's the one that you can just sort of pay for and keep watching. They are raising prices. They are cracking down on password sharing. But for me, at least, for a lot of the other streamers, it's more like event viewing, where it's like, okay, I'm interested in watching Star Trek Lower Decks, for instance. So I'll sign up for a month of Paramount Plus, and then once I watch the show, I cancel it. So I think if we continue to see subscriber numbers rise for Netflix in a way that they're not for the other streamers, I think there's a case to be made that people might be making that their primary non-linear TV, which that kind of consolidation is inevitable in the industry. Everybody's losing money on streaming, but that's one that I would sort of keep an eye on their subscriber numbers. If they come in and miss expectations next quarter, I think you chalk this up more to the entertainment environment, the labor strikes, and Suits being that monoculture thing.
Yeah, I didn't see that one coming. And we should note that earnings season will pick up more next week with some of the other bigger mega cap tech names, Microsoft, Amazon, Google, Meta, all reporting. So far it's earnings are definitely taking a backseat to other issues, but that doesn't mean they won't matter at some point. Maybe once the focus is off of both bond yield / Gaza. But let's move on to number two, big three. You mentioned one of the big success stories this year is the weight loss / diabetes drugs Ozempic and Wegovy from Novo Nordisk, and Mounjaro from Eli Lilly. Those have been two of the best performing stocks this year. I own both in stock of the week. We're up as of Monday. It's down a bit since then. It was up 83% in Eli Lilly in 7 months, and in Novo Nordisk it was up 50% year to date. Really, just on the strength of these, weight loss drugs. And then now what we're seeing is those drugs are so strong, and the sales have been so strong that the consumer staples companies like Pepsi, McDonald's, Coke, and then some med tech stocks have been sold off recently, because the thinking is that, so part of what these drugs do is they, correct me if I'm wrong, they curb appetite or limit appetite for certain foods, right?
Yeah, that's my understanding, is that it ultimately.
I don't know a single person who takes any of them, so I am just going off of what I read. Yeah.
Nor do I. My understanding is that it curbs the appetite by normalizing insulin and some like the metabolic pathways there. And what I've heard reported is that people that are on it, they're not saying, oh, I'm hungry or I'm craving these things. They're saying, I just don't feel like eating the things that my body used to tell me I felt like eating, like sweets and junk foods, the kind of the problematic stuff in our food system that leads to sort of society-wide obesity problems, right? It's like corn syrup.
Right.
Okay, so you don't want that. You don't want that trigger anymore. Nestle also came out and they pointed to, or they announced that they were going to be trying to launch some companion products for people that are on Ozempic and Wegovy, which I would presume to be maybe some sort of lower sugar sweet, or maybe a small package sweet, right? Because people are eating less of them, but maybe are still willing to eat some. They didn't really elaborate on the companion piece of it. I know that we had talked about Coke saying, oh, we're a little bit worried people aren't going to, or an analyst saying that they're worried that people wouldn't keep drinking Coke. Those seem like a stretch to me.
Big stretch. Yeah. This seems like a classic overreaction. Like, are people going to stop going to McDonald's? I mean,
half the people that eat.
I know tons of people who go to McDonald's I don't, like I said, I don't know a single person who takes any of these. Now, granted, it's early in its, in its life cycle, but
Yeah,
I
most
don't
people
think
that go to
yeah,
McDonald's do it because the food is affordable, or your kids
right.
like it, or you're in something of a, somewhat of a food desert and you have limited options. It doesn't, it's not as if the people that are otherwise shopping at Whole Foods and Sprouts constantly and not stepping foot in McDonald's, but are now on Ozempic, or now are like, it's like you're not
Right.
losing customers there. I do think that there will be the companies that are likely to suffer knock-on effects. There are some out there. You mentioned some med tech names. I could easily see somebody that's in like the gastric bypass space, and
Yep.
I don't have any specific names that are in that segment, but somebody that's in
I don't know.
a weight management sort of med tech segment specifically, I could see them taking a major hit. I wouldn't be particularly concerned about gyms because right, you don't have, that's not the only motivation, is not to lose weight. The one that did show up on my radar as being one that is probably likely to suffer is WW, Weight Watchers.
Yeah.
They've actually done fairly well this year. I think they're trading near 52-week highs, but a company that is exclusively dedicated to weight management seems like it could easily fall victim to an injectable, even if it is maybe outside of the price range of a lot of people that would otherwise use Weight Watchers. So I would lump them in with maybe some of the medtech manufacturers that are specifically looking at more invasive weight loss alternatives. Um,
Yeah. I mean, here's the I guess high level question. Would you be more inclined to invest in, let's keep it with consumer staples. Consumer staples, the McDonald's, Pepsi's, Cokes, whatever, that have been knocked back as a result of this, weight loss frenzy. You be more inclined to invest in those stocks after being knocked back, or Eli Lilly or Novo Nordisk they've fallen back the last few days along with the market, but are essentially at or near all-time highs.
for the next like 6 months, I would say give me the momentum with Eli Lilly and with Novo Nordisk, and that also gives you a couple more quarters of sales numbers,
Yep.
because I think that the deciding factor for these companies and some of the weight loss drugs is whether they turn into insulin, right, where they're life-saving and people are approaching them as ongoing maintenance drugs, things that they might be taking for the rest of their lives, or whether they're just much hyped, but maybe not super profitable vanity drugs. I'll say, I mean, I know it's a lifesaver, and I know it's a really significant, or contributes to really significant weight loss. And if you need something like that, God bless, by all means, use it.
Yep.
But one thing that came to mind was Pfizer prior to the approval of Viagra. Right, that's not a life-saving medication. It's something that is important, obviously, and it's
stuck around for 25 years.
Yeah, but
Yeah.
Pfizer ran from $14 a share to $38 a share or so in early in 1996, right before FDA approval, and then it didn't touch those levels again until 2007, 2009, something like that. So it's like, yeah, huge blockbuster drug, tons of potential. Half the population could potentially be dealing with the issue, but it doesn't translate to great returns for the investment. If these weight loss drugs turn more into life-saving, a lot of people are on them, long-term effective, not a lot of long-term risk. I have heard that there's risk to kidney damage, and that it causes discomfort, constipation, nausea, things like that. If the side effects aren't too pronounced and these become daily, monthly, whatever, life-saving drugs that a huge chunk of the population is on, yeah, they've got more room to run. But until they show that's the actual sales pathway, right now it's top of mind for everybody, and the people that want it are struggling to get it. So sales look great because you've got really limited supply. But what happens when anybody who wants it can actually get it? Do you have 20% of the population pick it up and start taking it, or do you have 2.5% that can afford $16,000 a year, or whatever the treatment cost ends up being? I think I saw
That's the
that
key. That's the key. Those prices, that's just not something everyone can afford. The general populace, way less affordable than Viagra. you
Yeah.
know. So I like both those stocks, Lilly and Novo Nordisk. Again, especially the next 6 months. But I don't see them fundamentally changing, the way the places people eat at, or the products people drink. I don't think people are going to stop drinking Coke and Pepsi or stop going to McDonald's as a result of these treatments.
Yeah, I would definitely agree with that. I mean, it's not like this is all new information and we're just finding out that drinking beverages with added sugar is bad for you. We've known that for
Yep.
40 years, or we've been well aware of it for 40 years, and the sugar industry has known it for 60, and they just didn't
Yep.
tell us.
Right. Yeah. Like most things.
Yeah.
Okay. So a smooth transition from weight loss pills and Viagra to Gaza. You and I are, we're not going to wade into waters that we can't swim in. We can't speak. It's outside of our area of expertise. All I know is, everything that's happening over there is pretty terrible. But how terrible do you think the market? Obviously, it's probably played at least some part in the market pullback the last couple of weeks, but it still seems like, maybe bond yields / Fed talk trumps all, even that. What do you think could happen there that would, make it a catastrophic event for the market specifically? It is a catastrophic event, but for the market specifically.
So the market has had 2 weeks or so, give or take, to sort of start responding. And what we've seen thus far is oil prices rise back to about $90 a barrel. I don't think that is a significant driver for any market participants right now. I don't think anybody's looking at what's happening in Gaza and saying, well, we need to reposition our portfolio. The bigger risk would be if it's spread regionally, right? If Iran becomes involved, and then you have oil production cuts,
Yes.
you have sanction enforcement. Bruce Kaiser of Cabot Value Investor wrote an interesting daily article that was talking about defense plays and how the war in Ukraine is sort of showing the lack of impact of the legacy defense companies. Somebody that he cited like the M1 Abrams tank. Like, well, that's a highly refined system and it's expensive to produce, but it seems to be losing efficacy in the modern battlefield, which has become dominated by drones. If you've got $100,000 drone that can take out a $1 billion aircraft or $100 million tank or something like that, he had a specific company that he cited that's in that space. So I don't have the name off the top of my head, but I'd encourage you to go back and take a look at that daily that he wrote. So I think that maybe
CabotWealth.com is where you can find it. Yeah.
So I do think that there is going to be some impact maybe on the margins with how the defense companies and with where we're putting federal defense spending. But unless we get into a broader conflict where you are starting to disrupt oil supply, I don't think that the market is going to give too much weight to what's happening in Israel and Gaza. And it's also not a new, I mean, they've been in persistent conflict for years. Ukraine's a big surprise, despite having lost Crimea in 2014. Nobody expected a Russian invasion. People have grown to expect, no matter how atrocious, conflict in the Middle East.
Right.
I mean, there was an old SNL joke that Chevy Chase used to open weekly, their weekend update with, and say, this just in, war in the Middle East, and it was played for a joke, and it's a tragedy, but it's also a commonality.
Right. Yeah, I guess so between Ukraine, Russia, which obviously is, almost 2 years old now, and the Gaza situation, which is fresh, and then the lack of a House Speaker here in the U.S., despite several attempts at votes. Which do you think has more of an impact among those geopolitical / political situations, impact on the market or certain sectors at the moment?
I would guess the lack of a House Speaker. I think that there's more um, calculable risks, right? If we don't have a House Speaker heading into the end of November, I think we're right up against another government shutdown deadline, and that starts impacting. We talked about it ahead of the last shutdown, but that has muted immediate economic impact, but it does start throwing wrenches in the works of things like IPOs, government spending. I mean, even now we can't send aid to you. We can't get congressional approval to send aid to Israel without the House
Everything's stalled
Speaker.
without a speaker. Everything in the
Right.
House.
Yeah. So I think that's probably more impactful. I mean, I'll be wrong if some other bigger players start taking advantage of all these little regional fires that are sort of popping up. If China starts getting aggressive with Taiwan or something like that, right? That would be a total game changer, and that would be the driving force. But if assuming the conflict is the conflicts that are ongoing right now, assuming that they stay sort of contained where they are in the same sort of theaters of battle with the same participants, I don't think that'll have a huge impact. But if it spreads, it definitely will.
Yeah. All right. Hopefully we got through all that without offending anyone. But if you are offended or not, streetcheck@cabotwealth.com is the website. And as always, you can give us a like or a 5-star rating wherever you're listening to or watching this podcast. Okay. Let's move on. As you mentioned, Brad, you were fresh back from your family vacation in Japan. I'm just going to let you cook for a little bit on it. Tell me about Japan. What was the trip like? What was it like over there? And we'll eventually tie it back into investing.
Yeah. So I don't want to just be like, oh, I'm the guy that came back from spending a week overseas and now has a different worldview and is a different person. I'm not going to.
I half expect you to be wearing a kimono during this podcast. Yeah.
But I will say, so we did the revenge travel, same thing that everybody else is doing, right? It's like we've been cooped up for 3 years, mostly. We've got a little excess savings. The pandemic was, I mean, I don't love it, but it was good for us. So we said, okay, we're going to do the bucket list trip to Japan. Started practicing on Duolingo, which we'll get to. I was periodically buying yen just to have for incidentals overseas, as the price is very favorable. That's something else that we will talk about. For travel day, first day, we left at 2 a.m. on Saturday morning. We traveled for 26 hours. We arrived the next night at like 6 o'clock, took a train, stayed in to the station by our hotel. Loved the city. I think I told you this offline, but it's the perfect big city for people that don't really love people. So if you're an introvert and you want to check out a big city, go to Tokyo. Everybody minds their own business, and just culturally, it's being polite is very important. Streets are incredibly clean. I had some concerns about the Japanese subway. I mean, you get some horror stories about things that go on in any subway, but it's to the point where in Japan, to sell a camera or to sell a phone that takes photos, when it takes the photo, it has to make a camera sound. I mean, that's like, so I'm not saying it's a perfect culture or anything along those lines, but it was definitely one of my favorite trips. Hit up Tokyo Disney, which was not ultimately worth it in my mind, for one of our like 6 days in Japan. But my kids are of the age where it makes sense to take them. It was beautiful. Went to Kamakura at the recommendation of Carl Delfeld of Cabot Explorer, who spent I think 5 years, 10 years living in Japan.
Yeah.
He's our resident Asia expert. So he had some recommendations, and saw a 12th century bronze Buddha cast that is the largest in Japan. Had beautiful time at some Buddhist temples there. Went down to the beach at Kamakura, which was very pretty, although you couldn't really jump in the water. It was a working beach that sort of smelled like diesel. My takeaways that might be relevant for somebody from a personal finance or investing standpoint are sort of threefold. Personal finance wise, if you're looking at a bucket list trip or are weighing different options for a bucket list trip or a major travel spend, factor in the exchange rate. We found that, the yen is at about 150 to the US dollar. Historically, it's closer to 100 or 110, although the last few years it's been in the more in the 140 to 150 range. There's speculation that the Bank of Japan might start buying up yen to sort of suppress that exchange rate. But from a practical standpoint, if I'm walking the streets of Tokyo and I need to hop into 7-Eleven to get my daughter some fried chicken because she won't eat sushi, when I spend 900 yen on some drinks and a couple of pieces of fried chicken and Japanese convenience store snacks, it's like $6. So just the day-to-day enjoyment, you're not worried about your incidental expenses, like coming home to a huge credit card bill. When you're traveling somewhere with a really favorable exchange rate, it does improve the experience. So something for spenders to sort of keep in mind. It saves you money, and it also makes it less of a mental overhang. So that would be one that I would recommend, is if you're weighing between a couple of destinations. And like for us, Ireland and sort of Germany and Japan are the bucket list spots. And Japan, partially due to us being closer to the West Coast, and partially being due to the presence of a Disney and the fact that we took our kids, the exchange rate helped, and it made the trip way more enjoyable.
Okay, so let's tie it back. Any investment takeaways? Now, I had Carl Delfeld on his on our monthly webinar last week while you're gone, and he talked a little bit about the Japanese market having one of its best years in a long time, up more than 21% year to date. But for perspective, it is still down over the last 3 decades. Let's see, the Nikkei, is he pronounce it Nikkei? Nikkei? Yeah, you would know better. Since 1991, more than 3 decades, the total return is just under 30%. This year's return, that's total. This year's return is 21%. So most of the gains in in the last 3 decades have come this year. So I asked him, like, is the tide turning for Japan? And he said it's investable, while there's momentum, investable. He didn't seem terribly bullish on it, I guess, was my takeaway. He didn't give any companies that he was super excited about. Do you have any companies that you're excited about, or Japanese sectors that you think could be good long or intermediate to short term bets?
I'm far less of a Japan expert than Carl, as we sort of outlined. There was one that sort of passed the Warren Buffett test for me, and this story might be apocryphal. I heard it when I was first starting out as a broker, was that the reason that that Berkshire and Buffett ultimately bought Dairy Queen is that he took his wife, or maybe then girlfriend, on a date there, noticed how clean the floors were. He was impressed with the upside down flourish of the Blizzard, which I don't even know if they existed then. I don't know Dairy Queen's timeline well enough, but those were the two things. He saw those two things. He said, "This is a great company. I want to own it." So I had on our flight home, we flew All Nippon Airways. It's what is it? It is
NIPPON, right?
Yeah. So it's trades as an ADR in the States under ALNPY.
ALNPY. Okay.
It's very, very thinly traded, like hundreds of shares a day thinly. So it would be a challenge to get into and get out of, but it does trade a little bit. The reason they had what is probably the closest I will ever experience to that golden era of flying in like the 60s and 70s, and that I know planes crashed a lot more often then, but that also was like the Pan Am. We had glass dishes or ceramic dishes. We had metal silverware. Everybody was super friendly. The seats and the planes were great. Wonderful experience. Part of the reason that I'm singling that out is shares are at 390 right now. They are sitting right about where they were at the March pandemic lows back in April 3rd of 2020. They were at 395. Japan was shut down to tourists for all of last year, and they were pretty closed up to tourists even in 2021. But their travel industry is rebounding a little bit. Their most recent figures showed that they were doing about 60% of the volume of foreign nationals coming into the country A lot of their travel volume was coming from mainland China. So if we do have a lot of ongoing economic weakness in China, that's going to be a drag. But I do think a place like, a country like Japan is going to then probably pick up some slack in the form of other international travelers like European nationals, North American travelers that are looking to travel to Asia but do not currently want to travel to China. That's been a big problem for China's economy, has been the lack of foreign dollars this year. People don't want to spend there. They don't want to travel there. So a country like Japan, given its proximity to China, given its sort of unique cultural offerings, could be a direct beneficiary of less travel to China. Obviously, the stock is not flying and it's hard to buy, but I think it justifies. I think it's justified to at least be on a watch list. If you wanted broader or an easier way to get broad exposure to Japan, something like EWJ is the Japanese. It's the iShares MSCI Japan ETF. Like the Nikkei, it's down 5% since the fund came public in March of 1996. But it's been in a solid, if slow uptrend going back to the great financial crisis. It's setting higher highs and higher lows. If Japan is actually sort of building a framework for navigating something that a lot of developed economies are going to have to deal with, which is an aging population that is larger than a young population, they've essentially got a 20-year head start on the rest of the world for facing that. So if they're actually navigating through it and their economy starts to strengthen and they become travel beneficiaries, I think that I would be in agreement with Carl that it's sort of good but not great.
Yeah, I mean, if you want to answer as to why the Japanese stock market hasn't been a great place to invest for the last 30 years. So I have GDP growth going back the last 25 years. It's only topped 5% year over year twice. One was after COVID. So the year over year comparison, after, markets around the world crashed. Yeah. The other was 2011. All the rest, it's been, more in the 1 to 2, sometimes 3% range. Right now it's 1.6%, at least in the second quarter of this year. They just, people talk about China's growth. Well, they grew 6% last quarter? It was less than expected and less than what they're used to. But yeah, as you said, Japan's a developed nation versus, China's still technically an emerging market. But the growth, what's that?
Oh, I trust numbers coming. I trust official numbers coming from Japan far more than I trust any numbers coming from China.
True.
I do feel like China's sort of made the wrong bet on real estate, and they're going to be working really hard to save face, more so than actually support their economy. So I'm a China bear I'm a most stuff bear right now. But when it comes to reporting and your ability to sort of trade some of these names without worrying about delistings or regulatory intervention, Japan is definitely a safer economy to invest in and a safer market to invest in.
Yep. Okay. Yeah. Unfortunately, right now, everything is about safety. Take one last look at the market U.S. market before we sign off. We're not quite below the October lows yet, but flirting with them. Hopefully, last week when Michael Brush and I were on here, we were striking sort of an upbeat tone. Stocks had actually had a couple good weeks. Well, this was not. This sort of coughed up most of those gains. So hopefully we'll be back in a little better place a week from now and be able to strike a little bit of more upbeat tone. But I'm glad you had a good trip to Japan and at least their market is having a good year. Again, give us a like or subscribe to us on YouTube or wherever you get your podcasts, and email us at streetcheck@cabotwealth.com if you have any questions, complaints, or compliments even. We will be back here next Friday, with a special guest. I'll make it a secret for now, but until then, hopefully the market gets better, and we will see you next Friday.